the series of the events for the founders. When Shaun will join us, I hope his Zoom will finally load. He'll tell us a little bit more about the name of the whole series, because he actually invented it. And today we have a very special guest to join us, because today we're going to talk about the investors and the dark side of the investments into startups. And we have a very special guest, Erik. So, Erik, tell us a couple of words about yourself, especially about your experience being on the both sides of the process.
Sure. How long do we have? Because this could be a while if I went into all of that history. But I'll give you the long story short version. I'm a recovering finance guy. So I used to work in the financial sector in Australia back in the day, moved to Europe and moved into tech, mostly corporate background. And then in 2017, decided to get into startups. So that's the short version of that story. Sold my shares in the company I was working for, and then decided to invest some of that maybe as an angel investor in a few startups, nothing significant or round leading necessarily, though I would love to someday, but more with the idea of focusing particularly on deep tech. So just a bit of a backstory, like my background was mostly in the investment space when I worked in Australia, like advising high net worth individuals on how to structure their finances for their family and for future. And so one of the things that became my obsession, I was also an analyst. And, when you look at companies on the stock exchange, which is what most people focus on when they invest, these companies are already existing phenomenon. They're going concerns. They're companies that are already running. They have already revenue and business and customers and everything. And the main approach that most analysts use is you're looking at a balance sheet and you're looking at broader sector and industry trends to figure out if this company is worthwhile. And I always thought VCs had to be super intelligent because they don't have a balance sheet like I did when I was an analyst, looking at companies on the stock exchange. So I'm like, what are they doing? Then I realized value and risk lives upstream of the balance sheet. And that's been my personal intellectual obsession, and why I moved into tech in the first place as well. Well, there's another backstory there, but that's the simple answer from a finance to tech. And so I'm sure there's tons of ways we can go with that conversation. So I'll leave that out there, but that's a bit of the backstory there.
Yeah, amazing. Well, I love this thing about, VCs being some, I don't know, so some people from the sky, I guess, from somewhere over there, like looking over on the startups, and the startups are like, okay, this is people from the VCs, they should be super smart. And if they say that my startup is not a fit, probably my startup is not a fit. And probably I should kind of, quit my startup and go find some day job or something. So, and that's one of the myths basically we are going to talk today about. Can you probably tell us some horror stories when you met some VCs, when you talked to some people, and then you realized that all these people are saying actually has nothing to do with the reality?
Well, I'm first going to say it is a hard job being a VC if you do your job right? Like if a VC is really going to focus on, early stage. I mean, let's just first understand what a VC is for the audience, who might not know. We all know they invest in startups, but where did this come about? How did this get started? So I'll try to give this story in a short way, but one of the earliest VCs on the planet was called American Research and Development Corporation. The idea of the company of investing in venture was you would get involved so early before, like I mentioned earlier, before the business is a going concern, before it's already got some traction, before it's already got some revenue. It's very, very early and it's focusing on R&D. Research and Development Corporation was the name of the company. And then this was back in, after World War I, before World War II, around that time. And if you think about what's happened since then, the idea back then was you do R&D, you get some VC or early stage investor to invest. And then once you're already churning and generating revenue, you would go to the stock exchange, you would do an IPO. You're already making money now. So, it's not early stage anymore. It's, more than 12 months since you've been churning and running the business. But if you look at what's happened over the years, a lot of investors realize that, you don't need to invest necessarily that early if you don't understand all the details. And instead, you can invest just before the company otherwise would IPO to keep them private longer. So you take advantage of the growth the company is still going to experience in the earliest stages when companies would have become a penny stock and then, make maybe like 100, maybe 1,000, maybe 10,000% returns from, 10 cents per share, let's say $2 per share. Even if you look at Google when they IPO'd to where they are today, like it's a huge return for those who invested early in the early stage. And again, that's early stage post revenue, not early stage of the business. It's a growth stage of the company. And by definition, a startup is just a phase of a business, right? So the reason I'm explaining all of these things is because you have to understand, for a VC to go very early, before there's market validation, before there's revenue, before there's a finalized product, just to evaluate a team, maybe some R&D, maybe some patent, etc., it is hard. And those who do it well, kudos to them, because they're doing the right thing. That being said, 99% of them that I've met, at least, are not that competent. Most of them are just looking to invest once the company's already got some traction before they will IPO. And they're just trying to take advantage of the growth phase rather than necessarily get genuinely early. Now, that's been the case for the last 20, 30 years. Most VCs especially are mostly doing that. They say early stage. What they mean is early growth, not early stage, genuinely speaking. So it's a bit of a misnomer. There are even VCs who say, we want to be your first check, but then they say, well, come back to us maybe in your second or third round. So there's a lot of false advertising, I guess you could say, from the VC side. And look, I understand it's a hard job, but to say one thing and do another, that's really where I think a lot of founders have a bitter taste in their mouth when it comes to dealing with VCs. Most of them, for example, they say they do deep tech, but they wouldn't know the difference between an algorithm and machine learning models. Like, they just wouldn't get it. And personally, my approach is deep tech. So as an angel, I wanted to only invest in companies that had some fundamental advantage, some patentable technology, something that has not been done before and is protectable under the patent law. Because that's, from bioscience to AI to compute, there are certain things that you can patent. And for example, this is how I met my co-founder and why I ended up going to the founder side. I was actually looking to invest in the company, but he asked me to come on board as a co-founder, and the rest is history. So.
Yeah. Well, but the whole idea of the VC is broken in this case, because VC is supposed to look at the really, really early stage startups. They're not supposed to look at, numbers in terms of, financials or something like this, because what are financials at the early stage? Actually, they don't tell you anything. If you have 10 customers, 100 customers, or 500 customers when you're early stage, it doesn't prove anything. Just probably that, yeah.
Yeah, finance and whatever you see on a balance sheet are lag indicators of business health. I've seen this in my corporate experience, right? Like, I once had an argument with a C-level executive at a corporate I was working for, where I said, look, we have certain problems in the business. And it's kind of like the joke about when a new CEO comes into a corporate, right? The best thing they can do to improve their quarter-over-quarter revenue is cut R&D and increase marketing spend. Right? Your numbers go up for one quarter, but then how competitive is your business going to stay in next year or 10 years from now if you don't have any R&D, if you don't have anything that continues expanding your edge in the way you serve your customers, in the way you serve your market and look after your team as well. And that's one of the things a lot of corporate executives get wrong, but also VCs especially get wrong. Funnily enough, even more so than I've seen in the corporate exec space. At least they have a little bit more skin in the game, I guess you could say. VCs where they're more spray and praying, they're just, essentially running gambling odds rather than actually saying, okay, I'm going to, understand a certain niche, and I'm going to really go deep into that and then really support these businesses and help them make and be a difference maker for these companies rather than necessarily just, money. And in fact, sometimes it'll be better if some VCs with just money rather than necessarily, trying to backseat drive the business. And I've seen founders complain about this as well. So yeah, that I can go into different stories about that as well.
Well, probably is, some problem of the hiring in the industry, because when you're looking at the backgrounds of a lot of venture fund managers, and again, for the startups, because a lot of startups, they never actually realize that those people who are working for the venture funds, they're just people who are managing someone's money, not their own.
Yep, that's right.
So they're basically the same as like bank clerks or someone else. And a lot of people who are coming there, they're coming from the banking backgrounds, stock exchanges, things like this,
Mm-hmm.
stock markets or something else. And they do have some, understanding of the spreadsheets, understanding
Sure.
of this financial things, but they have no idea about like what the founding team should be like, about the qualities of the founders.
Well, see, there's a very good. One startup I was evaluating when I was angel investing was in the real estate space, the real estate tech, and they were trying to automate some of the stuff that appraisers do, to value a property. Like, for example, when a property developer buys some land, they want to know, should I make a mall? Should I make an office building? Should I make a residential building? Like, what should I do with this land? And the term is highest and best use. And what they do to discover what is highest and best use is they look at what's called components of value, right? So an appraiser who is looking at components of value in a property example, how well is it connected? What sort of, surroundings are there? What's the condition of the market? What's the demographics in the area, et cetera, et cetera. All these components of value. Startups have components of value as well. Competence of the team, commitment of the team. I would put a huge emphasis on commitment of the team, and fundamental edge. And when I say fundamental edge, either that's market insight, and with the speed of that market insight, you can execute so fast by the time somebody else figures out it's too late, or fundamental edge from a patentability perspective, which is what I like personally. When I say deep tech, ideally, you don't just mean I have a lot of data from different people and I'm going to eventually get some model out of it, but you're actually saying that I've done something new from the way in which compute is done, or, for example, a new type of database, a new type of, way of coding or whatever, a new way of transmitting audio and video over the internet. Like, for example, our company at GameHunt, what we've actually solved is low latency streaming. So we can stream audio and video 10 times faster than every other company on the planet right now. And we've just filed patents for this technology. So this is the type of stuff I'm talking about when it says deep tech. And most VCs you would think would be running all over this, but in fact you get a lot of weird stories. For example, we were talking to a German VC. I won't mention the name, but they're managing hundreds of millions of euros, including EIF money, which in my opinion is misallocated. It shouldn't be given to VCs. It should be given as a top up to angels, but that's a different topic. But they literally said to us, hey, I don't understand why you guys are trying to go into the gaming industry with this low latency technology. Why wouldn't you do video conferencing? I'm on Zoom all day, but I don't play games. I'm like, okay, go to Google, right? And he's like, sure. I'm like, type in global video conferencing market, $8 billion. I'm like, okay. And he's like, guys, it's a huge market. You should focus on this market. It's a great way. Everyone's using Zoom right now, lockdowns, et cetera. I'm like, hang on. Go back to Google, type in global gaming market, on track to 200 billion, and then cognitive dissonance hits and they're like, but maybe you should try many things, maybe you get a third co-founder. Erik, you focus on, enterprise solutions in the cloud, your co-founder will focus on gaming in the cloud, and then you'll have a third co-founder who'll do video conferencing in the cloud, and maybe you have a marketing background. And I said, well, unless you're going to give us 3 times the amount of money and buy the same amount of equity, we're not going to run 3 different businesses. We want to focus on the highest premium value, And then funnily enough, that in itself was an admittance by that particular VC that we can do 3 different things because we're deep tech. We have horizontal technology. You can do multiple verticals on this horizontal, right? So he had pretty much admitted that we can do so many things, but at the same time was complaining that our valuation was too high. And I'm like, hang on a second. What is it then? Either we can do so many things, in which case you're getting a steal, or our valuation is too high, and then let's talk about that and how do you come to your numbers? But of course, when you ask them, how do you guys come to your numbers? They can't give you an answer any more than the founder can, And I love what, and in fact, I actually said this. You would remember this, Sandra, because I came down to Vilnius and I had this conversation to your startups in the audience like years ago. And I actually said, look, guys, this is before Tiger Global. I said, hedge funds are coming into your industry, VCs. You better be careful because they're going to move faster than you. They know that in the early stage, you're going to overpay, but that's fine because you want the company to grow anyway. And if it's not going to grow, then it's a moot point either way, right? And literally a year and a half after that I said that, and that's on YouTube. I think you still have it up there. Tiger Global came into the market. So, like I'm glad that more industry professionals with my type of background, the hedge fund space and the analyst space, are saying, hang on, these VCs aren't actually smarter than us. We actually know how things are done and how they look in the long term. Let's see how we can go and help these startups earlier. And I think that's a positive trend. That, and also the fact that you have this movement towards venture debt. There are companies like Pipe and Clearco. They're basically saying, if you've got MRR, we'll give you ARR as a loan, no dilution. So, I mean, really, if you're a VC or if you're starting to be a VC today, if you're not going early, as in properly speaking early, and you don't have the competence to be able to do that, you may as well pack up, give your LPs their money back. Because if I was an LP, I'll be furious right now, knowing what I know. But anyway.
Yeah, amazing.
Hey,
and I see Shaun finally joined us. We're talking about deep tech here, right? And he was trying to find Zoom.
This is exactly my area of expertise. Deep tech, hard tech, soft tech, no tech. You had me at your statement where we're talking about VCs and whatnot, and there's a quip from Hollywood that applies to VCs and investing. GPs, LPs, private equity, angel syndicates, high net worth individuals, all that. Nobody knows nothing. Nobody knows what's going to work. Nobody knows if the company's going to be amazing. Nobody knows if it's going to take off. Nobody knows if the team is really that solid as they appear in the deck. Nobody knows anything, and it's essentially, it's one big gamble. And a lot of people, especially founders, they get caught up in the hype. They get caught up if they read, Today in Tech newsletter that everyone's raising hundreds of millions of dollars, and why can't I? And they don't realize, one, it's extremely difficult. Two, just because you raise money doesn't mean that mean
you're successful.
Yeah, exactly. I mean, there's maybe we forgot companies like Zinja, Katara, Theranos, Quibi, Jawbone, Loon, companies that have raised 600, 700, 8 million, over $1 billion in funding, over $1 billion with a B, and still failed. They just still, so essentially people get caught up in the hype, and, it goes back to what I've always preached, is that focus on what you do best and focus on what you can do as a company. And really don't worry about the valuation and the amount of money you raise, because a lot of people, especially first-time founders, there's this hype machine. And this hype machine makes you think, oh, well, I'm worth $200 million on paper. It's like, that's great. What are you worth in reality? What are you going to use that $200 million on paper to do something with, do something real with it. And you can't do anything real with it until you get to that liquidity event, that exit event.
Let me ask you a question, Shaun. How do you believe VCs should be valuing in the early stage?
I mean, it's very difficult because at the early stage, most VCs, you got to go through the valley of excuses. Forget Death Valley. The valley of excuses to even enter. First off is it's too early. That's my favorite. It's too early. Shouldn't you want to get into something if it's early? Isn't that the point of being early?
That's where the money, the alpha is, right?
You want to get in when it's early. So that always kind of, annoys me because, it's too early. Because then if it's too late, it's like, it's too late. I wish I could have gotten early.
The translation of too early for the founders in the room is I'm too scared and I don't understand this enough to feel comfortable. That's really what they're saying if they were just being honest. But
I like that. Yeah. I like that. I don't get it. Just say that. Just say I don't get it. I mean, but I have to say, for the people that say it's too early, I at least have to give them a thank you of acknowledgement for giving me a reply. Because a lot of times you just don't get anything. You don't get an email back. We'll get a look at it. The partners are still evaluating it. We're meeting with the partners. We're evaluating all of our decks on Monday. So there's always that. There's always the family offices, which I find interesting because family offices like to put all the companies they invested in, the pictures of the general partners, what they invest, the check size, but there's no contact. There's no Telegram, Instagram, Twitter, Pinterest, email, phone number, 1-800 number, physical address. There's nothing. And it just makes me think, are you guys investors or are you starting a new chapter of Fight Club? What's the purpose of just putting your stuff up there and saying we invest and then nothing comes from it? It's just like, hey, I'm here. Here's my picture.
Exactly. And as someone who's advised family offices in the past, in the stock market when I was an analyst, like I wasn't the direct advisor, I was a paraplanner at the time. But basically, like one of the things I know is they do value privacy, but as a result of the way in which they manage privacy, which can be managed much more effectively than the way they're doing it today, they're actually ending up paying so much in fees and getting terrible returns. Because of the fact that they're not going direct and actually executing on their competence. Usually a family office is somebody who's built a business or a family who's built a legacy, right? And they've got the wealth and they've also got the competence in different businesses and business lines that they have. I mean, VC offers two things to a family office. One is exposure to companies with the privacy, but the other is hopefully better competence. I can tell you one thing, the latter I've seen is lacking. So privacy, I don't know.
Lacking is too strong of a word. Can we say non-existent? Can we say?
Look, there are some out there, very rarely, and I would include our current investors in this, who aren't necessarily that way. Like, but at the same time, they also are frustrated with the others because at the end of the day, they have to hunt in packs, right? Not every one VC has all the capital with them. So, if you need to do next stage rounds, et cetera, like you need to work with others. But unfortunately, those others might not always be the sharpest knives in the drawer. So, yeah.
I mean, it's very rare. Again, people think that because they're able to deploy capital, that
they're suddenly smart.
This deployment gives them an edge. But it's like, listen, every idiot right now is trying to start a fund. Everybody's trying to start a fund, micro fund, macro fund, a fund for this vector, a fund for this niche. It's all the same. And it's like, when it comes down to it, as I always say, everyone's a gangster until they want to write a check. Everybody,
exactly.
We do this and we've invested in this and we've come here and we've done that and we've done that. And again, it's like, okay, but when are you going to write the check? That's what it comes down to. And again, it's just a lot of back and forth, and it's the usual, it's the usual setup. And it's again, like venture capital isn't for everybody. Fundraising is.
It's not always the right thing.
Yeah, it's not. I mean, there's this notion, and like I said, I'm late to the party. I apologize. It was a Zoom problem. I was in Zoom purgatory.
It's fine. We have tech that's better than this, and VCs want us to do a competitor to Zoom. We're not going to do it yet, but maybe I'll.
You should. This is a test case. This could be the perfect opening to pitch night. Is to do it.
Coming back. By the way. Yeah, Shaun, coming back to this too early thing, because I'm like investor representative here, and basically when they're saying it's too early, it's just written over there, I'm afraid to take this responsibility, because it kind of, I'm hired by this fund, I'm an investment manager, and if I'm going to fight for this startup, if I'm going to bring it to the board and tell them like, look, this is a startup, it's so great, we should invest in everything. That's at the end of the day, the responsibility of the specific person who is fighting for the startup. And then you have to take this responsibility. And then at one point you might be even fired because you invested in the wrong startup, So things like too early means, well, I don't want to take this responsibility because I'm kind of afraid it's going to hurt me. I'm going to do and probably look for something safer, probably for something where I don't have to convince my board, or like to then talk to LPs and explaining them, well, we invested in this specific startup because of,
nobody gets fired for buying IBM, as they say, right?
I know.
Not yet. I'm sure you'll develop tech that allows them to be fired.
In our startup, you would be, but
I mean, it's also, everybody wants, especially early stage, they want angels. And of course, Silicon Valley has to take angels and take them to another level. Instead of just having an investor that writes a check, we have to be an angel or a super angel. That's the new thing. A super angel not only writes a check, but also advises, consults, opens the doors, gives strategic connections, lets everything come through. And then I don't know what's next, a super duper angel or an archangel, or in most cases for most founders, fallen angels and an angel of death. That's what they're going to kind of run into. And it's something where everyone is always, again, I need the capital. And, I come from a background of like, how am I going to make this happen? And I feel like everyone's kind of been like, well, we have to go get a minimum viable product, find an investor, find a backer, find another, do a round. It's all the same kind of song and dance. But if you can't do that, whether you lack the resources or you're not lucky enough to have warm introductions, or if you can even get an investor to talk with you or look at your deck or anything, what are you going to do? Are you just going to like stay stagnant? I mean, essentially, you have to beg, borrow, and steal to get to get this, this idea from inside to make it a reality. And a lot of people are stuck in the whole, oh, well, I'm waiting for this investor to look at it. And it always takes 3 weeks for them to look at it for a 10-page deck or a 15-page deck. So you really have to,
I disagree.
I tell founders
on
you
that
have this
slightly.
mentality that you have to kind of, make it happen. I don't care how you make it happen. You have to climb the mountain one way or another. There's more than one way to the top of the mountain, and it's up to you to do it because no one's going to make the climb for you.
Exactly.
And with that being the case, questions to the audience. I came a little late, but usually, put any questions, comments, thoughts in the chat. Put your LinkedIn in the chat. Feel free to network, connect, whatever. We've got 3 super smart people here to answer them. Well, definitely 2. I don't know about myself. Definitely 2, but that will answer them and will give you good feedback, at least to the best of their ability. So I just want to throw that out there because the chat's a little quiet. It's too quiet for me. So yeah, feel free to post LinkedIn questions, whatever. We will get to every single one of them.
And Shaun, you just mentioned the angels. Erik,
I was just gonna say with what you were saying about founders waiting for feedback, waiting on VCs, etc. Like in our case, for example, we were fundraising and we decided consciously how long we were going to spend trying to fundraise. And we realized that at the same time, the worst thing you can do to your business is lose momentum despite the fundraise. I mean, fundraising takes a hell of a lot of time from founders, way too much. And I think we're all as a species worse off for it because people who are trying to, build the future, build great things are spending time, trying to talk to people who don't get it. When, legally your customers aren't always allowed to invest in you, but that's a different topic. We can get into that. But one of the things that I always say to founders myself when I advise them, and one thing we've also done, is we will never compromise momentum in the business for fundraising. So if, for example, there's a VC meeting, but I have an interview with somebody who could really make or break up product and want to hire them, I'm taking the interview, the VC can wait. It's the same thing with, I'm waiting for feedback from a VC. Well, we don't have the money, so we can't do something. Well, find something else you can do. There's always something you can do. And it's about not necessarily just resources, but resourcefulness. Now, with that being said, sometimes there are situations where a business can't necessarily be viable without some level of capital injection, right? There's usually a bit of a hop you need to make to be able to be viable, especially if you're doing deep tech and something that is particularly R&D heavy. And that's really where I think we need better funding sources, not EIF money, not government mandated bureaucratic, red tape that, takes 5 months to even fill out the forms and everything. And
5 years.
Well, yeah, exactly. I mean, we're in Estonia, we're a bit faster here. But my point is we haven't used any government money or whatever in that case ourselves, unless the VC who invested in us has something. They probably do. But my point is, when it comes to being a founder, you've got to find a way with or without the fundraising and have a plan. If you fundraise, what are you going to do? If you don't fundraise, what are you going to do? If you raise less than your target, what are you going to do? And have those scenarios kind of, at least in your head, mapped out. You don't make a business plan for each use case, because any VC who's asking you for a business plan, not a hypothesis and a validation process, is not a VC. They're basically a real estate investor. They should go and invest in real estate. And
I like that. I'm going to start
give the
using
LPs. That. Yeah. I mean, because that's what you're doing in the early stage, right? You're testing a hypothesis. You're saying, look, I believe that if these things are true, then those things should happen. And that's going to make this business viable. That's all you should be focused on, not a business plan. So anyway, but I could rant about that. I know Sandra has a question. Go for it.
Well, yeah, I just wanted to, because Shaun started talking about the business angels, and the problem with the business angels that I see it now, because initially, like, who were the business angels? They were basically people who were investing in Broadway when they were running some show and they ran out of money, and they needed some more capital injection. Boom, there is this business angel, and they're giving the money to the show and everything. So at some point, business angels were actually those people who came very early with the money. And what's happening now in the market with all those kind of VCs that are afraid to go early, business angels are afraid to go early as well. I mean, we have this community of the business angels, and we see the change, and this change is not positive, because what business angels are trying to do, they're trying to jump in the deal together with the venture fund. So what's the freaking purpose of the business angel? I mean, you're over there to deploy the capital very, very early. You're over there to help startup as much as you can. and you're over there, like you are taking the highest risk, but you're getting the highest return at the end of the day. And when they start behaving as VCs, there is basically no one left on the market who is deploying this very early stage capital.
Mm-hmm. Well, I mean, I would comment on that a little bit. Risk, I mean, the word risk is always, thrown around, because especially when you talk to the gambling type of investors, they always say, well, high risk, high return, right? So they either like, chucking money in everything, something will go up, or they're kind of like, super scared of everything. I think both are wrong approaches. Risk is a function of your level of understanding. I repeat that. Risk is a function of your level of understanding.
I like that.
Right? Now that's something that you as an angel will never know everything about everything, nor can you as a human being. I wish we could, but this is life. We all specialize in what we specialize in, but usually through the founder. And look, I'm going to try not to rant too much about this, but there's so much emphasis on founders being able to pitch and articulate what it is they're doing, how they do what they do, etc. But there's very little emphasis on investors learning how to understand different areas of competency that they want to invest in. Like, why isn't there just as much emphasis on comprehension capabilities as there is on pitching? Everyone says, tell me a story, pitch and hype me up. It's like, well, if you invest in hype, then go invest in crypto and see how that works out for you. But I mean, at the end of the day, was that a
recommendation?
Not investment advice.
Okay.
None of this
Put that at the bottom. We're not financial advisors. Startups include a certain level of risk. You could lose part or all of your investment. Seek a financial advisor before making any investment on your own.
But to go back to risk is something that is, like if I was investing in, I don't know, a fishing boat or fishing expedition, I wouldn't know, whether I should invest in one or the other. But someone who's been a fisherman for 20 years of their life, they're going to have some level of insight that I'm not going to have, right? So if you're an investor and you want to invest in a particular, type of business, first try to understand logically yourself what it is you're getting into, right? Like that's something for any angel. I'm really trying to help the angels here because VCs should know this. If they don't, well, I hope they learn something too. But honestly, whatever. But my point is understand yourself, because even if you go to an expert, especially these kind of certified experts, board certified, they tend to be the ones who have the most to lose, usually from something genuinely disruptive. So their feedback will be colored by it sometimes. But at the same time, and NDAs come into it when it comes to deep tech, et cetera. If it's pre-patent, there's a whole bunch of complexity to it. But my point is, if you take the time to try and understand and you apply your own logical thought process, the same structure of argumentation, you're going to be able to figure out if this, what are the hypotheses that this startup needs to test in order to validate a market. If you can't, as an investor, as an angel, do that, don't do angel investing. You'll be better off, and the startups will be better off not having to deal with you. So it goes both ways. And same with VCs. If you can at least intellectually understand what are the hypotheses this startup needs to test to validate a market, and you can actually articulate it as well as the startup founder or better, and then you can help other investors come into that business, then you're an angel that the startup really needs. And that's the angel I was trying to be. Obviously, I ended up becoming a founder. So, but at the end of the day, and because of that reason, we've been able to say no to deals that we didn't feel were right for us. We've actually rejected 1.1 million euros in this last fundraise we were trying to do. And we only took a much, much smaller amount. But the reason we did that is because we felt the investors attached to the money were going to be a net negative to the business despite the money, and it's a good position to be in, but I know not every founder is in that situation, but that's why I go back to resourcefulness. It doesn't mean that I'm not rolling in cash either, I still got bills to pay and everything. But my point is don't rely on the investor, or don't just take an investor because you're resource strapped. Find another way, because it's better for your dream and for what you're trying to build. If you're genuinely doing something innovative, then if you just take the wrong investors and, nobody's happy, you may as well just close up shop,
Yeah,
So.
I mean, again, founders think that once they get the money, even if, let's say, from an angel, they think, St. Michael's going to descend from heaven and give them a check for $2 million and they can do whatever they want with it, no strings attached. And the game doesn't work like that. They think that, again, once the money comes in, it's all over, we're good. And they go back to the companies I talked about earlier.
That's when the work starts.
You got to have, there's got to be something going on where you raise $1 billion and you fold up shop. I mean, come on. I don't want to mention any specific names, but Quibi, I mean, it's
Yep.
like, come on.
I was just going to say Quibi.
Yeah. What could go wrong with this, and a perfect team, perfect idea, perfect tech, perfect talent, everything, and it just doesn't work. So
it wasn't really, but that's a different topic.
well, you're the tech guy, I'm the one saying, as a screenwriter, this could be really kind of cool. Before I could even test it out, it was already closed. So, it's essentially, it's people think that once they get the money, the battle's over, and it's like the war hasn't begun yet.
Exactly.
You can't say that it's done when we're just getting started. But with that being the case, we do have some questions. Like I said, I want to get to it, and I feel these are questions more for you that you could answer. What's your favorite red flags when talking to angels and VCs? I mean, I got plenty, but I want to hear your perspective.
Well, there's kind of three things that I would be careful of. The first thing, and it's not like necessarily just bullet points. I'm not going to give bullet points. I'm going to kind of describe ways in which you can uncover it yourself as a founder. So one thing is try to understand how that particular investor works with teams. Like you can actually ask them, like, so once you invest in a team, how do you work with them, and how would you work with us as an angel or as a VC? What I want to hear as a founder is, I'm going to help you find money for the next round, or I'm going to make sure I have some for your next round as well, so you don't have to waste time fundraising and you can focus on the business. That's number one. Like, do that, match made in heaven. The other thing you should be looking for is try to understand, like if somebody says they want a board seat or they want some level of control on the actual company, corporate structure itself, make sure they're worth it. Think of it as if you're hiring. Forget for a moment that they're giving you money and start thinking, put your employer hat on and say, look, is this person competent enough, savvy enough, capable enough to add enough value to justify me giving equity with or without the money? If they're not, I would really question the value of giving somebody a board seat, right? I understand they have to protect their investment. Put some liquidation preferences in there. Put some things in there that's in the contract that says, if everything goes bust, how do things get divvied up? If you need a board seat for that, no, you can put that in a shareholders agreement. You don't need a board seat for that. A board seat is control for the long term on a lot of other things. And as a founder, guard your board seats. The other thing that I would also say is try to make sure that like people will be very friendly to you in the early stage if they want in on a deal, especially if you're oversubscribed or if you're, got something that you can demonstrate like we did. And like I said, we rejected money. But try to make sure that the commercial deal makes sense to you as a founder. For example, we had somebody actually offer us like 300,000 euros saying, look, I'll give you guys the money, do whatever you want. I don't even care about a board seat. But like, oh, okay, cool. I mean, we appreciate the vote of confidence. And then ended up saying, but I want the right to use your tech to do video conferencing in my own company, as a side thing. And I don't want to pay any license fees to your main company. I'm like, well, that's actually not good, not only for me, but not good for my other investors as well. Because you're getting a free license to run a completely separate business vertical and we get nothing. No, so again, people will, this is very obvious as an example, but there are other examples also where people will try to put things in the contract. And as a founder, you better be commercially savvy or get someone who can actually help you with that, who's independent. Because, and this is the value of, accelerators like Baltic Sandbox, et cetera, where they can actually help you logic check these types of things. But I've seen a lot of deals that really founders should not have signed. They just were young. I mean, this is also why people focus so much on 20-year-old founders, because they think, hey, these are 20-year-olds. They don't understand, commercial contracts and everything. I can pull a fast one over them, get a huge percentage of the business. And then if it goes well, great. If it doesn't go well, whatever, So try to avoid being that founder in that example.
Okay. Wow. For all the 20-year-olds in the chat, yeah, be smart, be savvy. Wait till you're 21.
Or message me if you want me to look at something. Like, honestly, I'm more than happy to help. Like, if an angel genuinely wants to understand something deep tech and wants to understand and comprehend and be a better investor, I'm more than happy to give like a perspective, obviously, if no conflicts of interest. If a founder needs help, message me on LinkedIn. I'm happy to help fellow founders, because I genuinely think the ecosystem is not going to change unless we start pushing back and say, look, this is not intellectually honest. This is not, an honest way of doing business. And there's a way to do things and not. And so I think unless founders, because look, you guys are building the future. You guys are building the next billion-dollar companies or multi-million-dollar companies, and still respectable to be a multi-million-dollar company. You don't have to be a billion. Only VCs want that, but they actually don't. But that's a different topic. But anyway, that's my point, right? So, you have to protect what you're building, and you have to give it the best chance of adding value in the world. Otherwise, don't don't do it, because you're not going to stick to it. If you're not willing to get up and struggle for it, you're not going to do it. And that's really what I want to invest in if I'm an investor, and this type of founder that we are as well, which is why I agreed to work with my co-founder, because I saw a deadly commitment to building what we're building here. So that's the other thing that I keep in mind.
Yeah, it's again, as I said in the last episode, which I'm sure we have a link below, in case you missed it, it's that you have to be worthy of your sufferings. That's what being a startup founder is. I mean, you have to really. This is something that consumes you. This is something that you're going to do whatever it takes. And a lot of people get pulled in different directions. And it's like, you can't get pulled in different directions. This is something that you have to be in it for the long term. This is something that you have to be, if it does fail, which the odds are probably it is going to fail. Let's just be honest. I mean, most of the time, these are all experiments. You have to be able to bear, what others deem as shameful as being, a failure. And which it's not, failure should be encouraged, and there's nothing, there's nothing to be ashamed of. But yeah, it's very difficult. And again, we have a pop culture kind of entrepreneurship thing where everyone's got a Ferrari, everyone's got a Ferrari and a Lamborghini, and the founders are hanging out.
Hey, I don't want a depreciating asset. So.
Yeah, it's just like, you're going to be I tell everyone, you're going to be way too busy to be doing any of that stuff. Like, if you can manage to get to the company to that level, you have the Ferrari and all that, that's great. But most of the time you're going to be working and taking meetings and being 7 days on and just hustling and trying to get things done and trying in most cases to survive another month and then another month or close one more deal. And it's really, it's nothing fun about it. And especially the fundraising process, even though I like to say I put the fun in fundraising, that's just my good natured cheer to keep you going, because at the end of the day, you're going to have to go through hundreds of investors to get to that one or two that, think this is a good fit, if you can even get to that. All right, next question. What are some other criteria that you look for for investing besides market valfavalidation?
Well, I haven't answered. Just a second. It's also me here.
Okay.
Hello.
My fault.
Yeah. Okay. No, I just wanted to add something. So imagine when you kind of get married, right? You're actually thinking a little bit that you're going to marry this person and you're going to spend the next 10 years, 3 years, or probably the whole life together. So same situation with the investor, basically. But you can divorce with your spouse. You can divorce with your investor for the next 10 years. So do you really want this person to be in your life? Do you really want this person to be the part of your team? And do you really want to spend with this person more time that you're spending with your family? That's what's going to happen. So when that's the main red flag. If you're looking at these investors and you're thinking about them, well, I probably just need their money. I don't like them personally, but whatever, I just need money. It's not going to be like this. They are going to be all over your hair. They are going to be with you 24/7. And if you don't like them personally, if you don't share the values, if you are completely against everything that they're doing, just kind of turn around and run away. Because if you're having the wrong investors, the best thing that can happen to you if your startup is going to shut down, and everything else are much worse. Believe me. Yeah, we're coming back to the question about.
I don't know if you want to take that question first, Sandra. About what else would you look at aside from market validation? I'll let you go first. So
well, it's from the very beginning. The early stage is not the market validation that comes first. It's team. It's the team of the startup that comes first, and nothing else. Because actually, what happens with the startup during the first 3 years, from the moment they actually had some idea and started building something, they might change the value proposition. They might change the product completely. They might change the market completely, and something else will be happening. However, what won't be changed in most of the cases is the team. So this is something that you actually should evaluate. Because if the team is bad, however good the idea is, however attractive the market is, just nothing will happen in this case.
That's a very good example. Reminds me of Slack, for example. They were a game. They were trying to build a game before. The game didn't go very far. They pivoted to Slack, which was an internal tool they were using for their own communication. And then next thing you know, it spread like wildfire. They exited for 26 billion to Salesforce, right? Again, it took a lot of time before it happened, from the game failing, the pivot, the founders, but it was a team that made that possible. They were obsessed with the level of quality, and they were obsessed with making products that are fun to use. And they applied that from the game mindset to a communication tool for enterprise, So that's exactly to your point, Sandra, that team really, really matters. Aside from team, I'd also talk about, if you want to be a bit more dry, like I'd say, yes, the team matters a lot, but also fundamental IP, I would say, is very valuable because, look, the founding team matters. Employees can kind of come and go as well in a startup, but ideally you want a founding team who's been able to attract competent, intelligent people, because look, competent, intelligent people, like you can't hire me for some companies nowadays. I would not work for certain people if I don't respect them or at least see them as intellectually people I can learn from. I'm not interested in working for such people. And so, especially people who are like the top end developers, the top end product people, the brilliant designers, etc., like they're going to work for people they respect. And they'll only respect competence when it comes to an employment situation, because that's their vote of confidence in the business. For example, we have 10 people in our team. Not all are working full-time, part-time, etc., because we're still in the fundraising phase. But at each one of them has gone way above and beyond. And like if I'm an investor looking at I've seen other startups like this as well, where they have team members working, paying their bills, compensating other ways, but they're still trying to support the startup. Why? Because they're committed to the vision of the business and the vision of those founders. And that's better vote of confidence than a VC investing. I would rather see some really competent developers, designers, product people, team members work with a company. Sorry, one second. I have a battery low.
No worries. While you're talking, I'll just chip in about this one. You said IP, and that's one thing which is also really important. The mindset of protecting the assets and protecting the team and protecting the whole project
IP and
the
strategy.
Investors. IP and strategy, and that's why when we're talking to startups, sometimes we tell them, okay, guys, do you have like shareholders agreement? Do you have this and that? And they're like, oh no, it's maybe too early. Well, it's never too early to think about what's going to happen to you and your co-founder in 5 years. I mean, what happens if your co-founder just takes off and goes to Bali to spend like all his life, swimming in the ocean and everything? What's happening with the company in this situation? And unless it's kind of somehow protected, I mean, you invested everything in it and it's not protected, it's not wise from investors' point of view and from anyone's point of view, I guess.
Yeah. I mean, they always say you're only as free in a society as you are free to leave it. Likewise, you're only as your contract's only as good as you know what happens in a case of disagreement or if things break up, right? So you want to ideally have those things very clear, both with team and also with investors. So.
Shaun, I guess the next question is yours.
Oh, okay. I was going to answer this one still, but don't worry.
No, you can go. But the next question is just yours. We are going
all right, I'm going to just agree with the last one and say team. What else can I say to add to it? Okay. Oh, wow, it is mine. How important is resilience in terms of mental health or wellness to be a founder? Oh, well, it's definitely my question. I think it's just the most important. I mean, being a founder is you have to be resilient, because every single person is going to tell you it's an excuse for why it's not going to work, for why you're wasting your, let's just go down the gamut. You're wasting your time. You have no experience. You have too little experience. You don't know anything about this vector. You're too young. You're too old. You have no resources. You don't know anything about it. All that. It just comes down. And these are from people These are from people that like your friends, your peers, your teachers, your family. I mean, it all comes from, everyone in your life before you even get to the stranger that's like, hey, I'm doing this, so I want to do it. And, it's even, you're even going to have people that if they like it and they like you, they're going to try and tell you, oh, well, you should do this. They're going to try and take over, and they'll know nothing about the business. They'll know nothing. Back in my nightlife days, and I was thinking about this the other day, just because it's something that's happening with every industry I've been involved, but it was always with nightlife that it kind of, when I started, that I saw it first, is that people will come and support you, future customers, partners, managers, whatever. They will come and support you provided that you get a hot account, right? But as a startup, you're not going to get a hot account. You're not going to get, a major publicly traded company as your first client. You're going to get, a client as like, oh,
and if you do, increase your valuation.
Yeah.
Yes,
if you're going to get a client with 3 people, it's like a small team, 3 people that they have very little money. No one's ever heard of them. They're probably going to be closed in 2 months. That's going to be your first client. And people be like, well, if you can get a bigger client, I'll come help you and I'll do this and you can prove it. And it doesn't work that way. You have to kind of start you have to take the good business is where you find it, and when I was doing nightlife, my entire, I don't want to call it a career, that's giving it too much importance. It was essentially the money I made was taking, the places that nobody wanted to go to on the nights nobody wanted to go out for the money nobody wanted to work for. That's how I built the business, and that's how I built the reputation, and that's how I built the following. You have to do your own thing, and it's very difficult, to do your own thing in a world that's saying, oh, well, look, everyone's doing this, and there's 50 other competitors, and they're doing that, and look at me. Why am I not catching up to it? So resilience is the most important part. There is persistence overcomes resistance. That's what I tell everyone, and you have to have this resilience and this tenacity to go your own way. To say, well, you want to know what? I'm going to go after this. I don't care what you say, because who are you? You're not an investor. Mm-hmm. You're not a customer. You're not even a supporter. Why should I listen? Why should I even go forward listening to this person? You have to follow an inner compass that tells you where to go. And that's what I feel like most of the most successful, not even founders, but successful human beings have always went their own way. They always saw something that no one else saw, and they went after it, despite what society says, despite what the market says. They did it. That's it. And it sounds easy, but at the same time, it's the hardest thing, because you have to be able to, just get beat up every single day and wake up and wipe your bloody nose and say, okay, I'm here again. Here's my next serving. Let's have, the door slammed in front of my face. Let's have someone not get back to me. Let's have someone give me an excuse why it's not going to work. That's the entire game. So if you don't have resilience, you're not going to be a founder. You're not going to have much success at anything, because anything that requires, a lot of work, a lot of grit, a lot of determination, anything like that requires you facing pain, requires you fighting back, requires you going forward, no matter what the difficulties may be, no matter what the circumstances are. And, there's an old samurai quote that says, the more hardship, the better. A lot of people don't want to hear that. Oh, I want to hear a life of no obstacles, no hardship. And it's really that's a myth. Nobody overcomes a life of obstacles to enter a life with no obstacles, especially a founder. Even if they get to the level of, getting funding, even if they get to a level of success, it's not that the problems go away. They're still human beings. And we've had, there's just, you can look at issues of people that just had, they had success professionally, but personally their lives were a mess. Personally, they just were destroyed. Mentally, they were destroyed, even though they were amazing. You see it, across vectors. So you have to have this resilience, and you have to have this mentality of, it's not, the Ayn Rand quote, it's not the question isn't who's going to let me, it's who's going to stop me. That's the kind of quote that I always like to use. And a lot of people, they wait for permission. Oh, I have to wait for permission. Going back earlier, I have to get the first check, second check, first round, second round, hire this person, get the team, get this account. They set up so many barriers to their own success that, they never move forward. Being a founder is just being scrappy and moving forward and making something happen, taking nothing and turning it into something. I think that's what it is. And resilience is extremely important. And, the mental health factor, again, is, you are your own worst enemy. And we all suffer more in imagination than we do in reality. That's just the fact that it's always worse in our head than the reality of the situation. So you have to kind of contend with yourself and conquer yourself first before it can go conquer the market, because, lions circle the hesitant prey. So if you're not really committed to what you're doing, and you're not committed to the vision, you're not committed to the company, you're not committed to the idea, to your team, to your people. People can see through that. They know who has it and who doesn't, whether they're a customer, investor, or just a fan. So yeah, it's a long-winded answer, but yes, I think resilience is probably number one. Resilience, persistence, grit, whatever you want to call it. We all need that as a species, but especially as a founder, because it's 10 times harder as a founder. So I hope I answers that question, because now we have a big one to you, Erik. Okay. And this one is all you.
All right, tell me.
Okay.
Let me take a look here.
Yeah, take a look. It's
yep. Circle back to my comments.
This is a story problem question. So
sure. Well, so the question is, buying into a hypothesis as opposed to a business plan. As a former financial advisor, how did you articulate that to family offices or private investors who lack that sort of way of thinking? I find many private investors want business plans. Look, I understand. I'm guessing this is a founder asking the question. If somebody's asking you for a business plan, And look, there's ways to do it. There's tons of information online. I'm not going to explain how to do a business plan. It's online. And if you really want help, like message me. But generally speaking, these are people who are already well capitalized. Like if I'm already working at a family office and I'm, I don't know, son of some oligarch, and I decide, hey, I want to start this new business, I'm going to come up with a plan because I already have the capital's green. I just need to know how I'm going to deploy it. And to an extent, in a business, in a startup, there is a level of business planning that you can do. That being said, what's more important than minutia of planning is understanding deeply who you're serving, right? Who is it for? So Seth Godin talks about this. And honestly, like, I would say rather than spending energy on business plan, read everything Seth Godin writes, particularly around marketing. And he talks a lot about this concept of who is it for and why does this matter, right? At the end of the day, you have to be able to answer those questions in your business. Who is this for? Why does this matter? And the why does this matter is faster, cheaper, better, etc. But also, what is the impact it has on the person who it is for? So it starts with who is it for? Who's your customer? Who are your target customers? And sometimes there can be many. Sometimes you don't know. You need to still figure it out, but you'll have some level of hypotheses around that. And so if you notice in this thought process here, let's say, for example, I'll use my own business as an example, right? So we have low latency streaming technology, audio, video over the internet, faster than everyone on the planet. It could be for people who do video calls. But then again, if I say video calling, like who? Is it the Zoom users? Zoom users are a very broad demographic. Why don't I narrow it down? People working for a business, people trying to connect to their family, like you can narrow it down and get really, really minute in terms of who is it for. Now, what you want to ideally do as a startup founder is when you understand who is it for, you want to figure out who has the highest premium value to solving that problem. So for example, the video conferencing market's 8 billion, the gaming market's 200 billion. What that means is people are more willing to spend money on games than they are willing to spend on video calling, right? So maybe there's a higher premium value in gaming. Likewise, in gaming, if I have a 4 millisecond delay, I'm going to die. And, like my character, I can't have a good game. But if I'm on a video call, worst case, I'm going to talk over Sandra and Shaun over here. And you'll say, oh, no, you go. That's fine. But I mean, we still continue with the call. Will it be nicer if I didn't have that problem? Yeah, it would be nicer. But will I pay extra for it versus will I pay extra for a 4 millisecond shave off on my time on a game? I'm going to pay more for, the shave off in the game because people really commit to these experiences. So figure out for whom do you have the highest premium value from a customer perspective for the thing that you've built. And then articulate how you want to serve that customer and get this in their hands in a way that is financially viable for you as a business. That's fundamentally what a business plan is. Now, if somebody's asking you for a business plan, either they didn't understand what you've already told them if you've had a conversation. If they're asking for you to give them a business plan on the upfront, I think you should ideally have a conversation first and get to know them as a human being, and articulate again your hypothesis and your value proposition and why you care about this market or building this thing that you're trying to build or your vision. If they're not bought into your vision, it doesn't matter how solid your business plan is, you've just wasted your time, right? So make sure that they at least agree with you on the vision. They're bought into you as the person to make that vision a reality, and they've bought into the concept and the customer you're trying to serve. If they're not bought into that, forget the business plan. They're not investing anyway, so don't waste your time. And honestly, your business plan is going to change anyway.
Yeah, probably just like one thing that I wanted to add about the business plan. We are asking for the financial projections sometimes. And we do understand, and we actually always teach startups that financial projections is like non-existent anymore for the early stage startup. However, why do I want to see financial projections in this case? I want to understand how you think.
Correct.
And I want to understand if you are really, really able to do the simple math. Because you would be surprised how many startups are simply unable to do this very, very simple math. And
don't worry, VCs can't either.
Yeah, I know. I know. That's both sides.
Sorry, but it's true. Yeah.
I've seen things, believe me. And also when it comes to the business plan, we actually do this exercise on the business plan with the startup. Why? Because it sharpens your strategy. And when you're building this, financial projections for the next 3 years, and then when you're sitting down in your computer and trying to describe the actions that would actually lead you to the numbers, you kind of start understanding that sometimes your the financial projection doesn't make any sense. It's like total bullshit because you're just unable to execute it in like any way. So business plan is not about writing the formal paper. You're not writing your master thesis or something. Business plan is about the way how you think and how you're going to execute, and same with the financials, basically.
And I can give you an example back in our case, right? So one of the things is, for example, these companies that have these scooters around the place, right? Like Uber, Bolt, whatever, Lime, they usually have like approximately 3-month payback period from what I've heard. So that's the time it takes for them to get the capital they spend on buying these scooters back from the revenue they're making in the market, right? Now, as an early stage startup, let's say you want to do scooters, you're not going to necessarily already have scooters or customers. So you can't necessarily say this is based on something real, but you can at least make an educated a hypothesis of what is it likely to look like at the mature state, right? What you're trying to do when it comes to business planning as a founder is try to figure out, once your company reaches mature state, i.e. it's already chugging and now it's just a matter of money in, grow, not build, what does your economics look like? Like in our case, our economics, like if we set up game servers to pay back to provide this to customers who are playing games on our cloud, we have less than a month payback period in certain cases. Now you need to know your numbers, right? So but this is what I'm saying. I can give these numbers when I'm talking to an investor if they're interested in that. But if they're not bought into who we are as a team, if they're not bought into investing in this space in general, it's not the type who are going to take a risk, not bought into the vision, I'm not going to start talking the economics. But you as a founder need to know your economics. You need to know your numbers, because that helps you create a healthy business, which is going to be sustainable once you get to that stage. And you owe it to yourself and to your team as well to do that. So
I'd say like business plan is not for the investors. It's for you to understand what you're actually doing.
Yeah. Investors will ask you because they want to know that you know, and that's a valid question. But again, try to make sure that you, having done your homework, and again, it's not going to look like a business plan, but it's going to have some hypotheses, it's going to have some assumptions, and it's going to have some formulas. And you need to know what those economic factors of your business health would look like. So,
thanks, guys.
Yeah.
Next question for me. Wow, I'm going to open this up to everyone though, but it's for me. So, can you speak more about minimum viable product? What to launch immediately? I mean, I can. But we got Erik here and Sandra, I feel like take it away, because I can definitely easily talk about it, but I think you
ladies have a first. Go for it, Sandra.
No, I mean, we have time for the last question from
Sure.
what I actually say. Well, minimal viable product is very, very simple. It's something your customers are paying for. That's it. I mean, the product can be really, really ugly. And I've seen a lot of cases like this in our portfolio, in our community startup, when the product is ugly, but the customers are paying. No matter how much they're paying, the product is viable because there is value in it for the customers. I've seen a lot of tech. I love tech startups. Don't get me wrong. I love those tech people creating like the best solutions on the planet and everything. But I've seen a lot of problems with the techie tech founders who are building the product for the purpose of building the product. And they're building this product literally for years, and they love the product, and they're afraid to sell it. They're afraid to sell it because they know when they will go out there in the world, they will get a no. And they can't bear the no, because I was building this product for 3 years and you say that you don't need it. Like, why did it spend 3 years on building this product? And they end up in this story when, okay, so basically those customers, they don't understand my product. My product is so good. Erik, you remember this one? You've heard this.
I know who you're talking. Yeah, exactly.
Well, yeah. I'm talking about like several startups like this. It's not just this one. So my product is so good that you don't understand it, so you don't buy it. But I don't care because it's so good. I'm gonna go on building it. It doesn't work like this.
Yeah, no, that's absolutely right. Now, I was just gonna add to that, like. There is an element of that. I mean, a lot of people say, who's your customer? And sometimes people say, well, everybody would use this. Like, like, for example, if I'm doing video calling, right? I'll say, well, everybody could use video calling. Well, no, not everybody. Tribes in Timbuktu might not. So like, there's always people who won't. And there's some people who might be more privacy conscious and they don't use video calling at all because, they think the NSA is spying on everything. But let's not talk about Zoom security issues. But anyway, but my point is, like, there is an extent of figuring out who your customer is. And yes, some customers just won't get your product. But if you're doing it because of fear, like Sandra described, then you're doing the wrong thing. You want to get it in the hands of people who at least will give you honest feedback. Even if it sounds petty and fickle, that's your customer, right? So customers can be petty and fickle. So, like figure it out and figure out, is that your right customer or your wrong customer? And if they were your right customer, then maybe you're building it wrong for that type of person. It might be a product problem, might be a design problem, and it's not always a technical problem that somebody might have to using your product. So there's a lot of nuance that goes into product design and effectively getting that to market. I think founders need to, I always say, there's the person who builds it, the person who sells it, and the person who manages everything else. So you, as a founding team, ideally you'd have at least 2 or 3 people who can kind of do that and create that. So people who can build it, but people who actually understand the customer and wants to put it in their hands. Like one thing I like about my co-founder is he's not only the type of person who invents stuff and builds stuff, but when he puts it in a customer's hands and sees their facial response and they're loving it or they're not, that's his obsession. And that's very rare to find in a technical person, but it's not uncommon, as uncommon as you might think. But at the end of the day, yeah, you need to be able to get that feedback loop going with your customers or your early adopters as early as possible. One thing we did, for example, when we were pre-patent, we wanted to get some validation if we're in the right space. We launched a wait list. We didn't finish our patent process, so we couldn't actually serve these customers, but we put a wait list up there, and we've actually had people now, we've just launched this weekend, where to the people on that wait list, and we're getting them to beta test the product even without the tech initially, and then to validate that is the context within which we're deploying our tech valuable enough for that customer base. So there's ways you can still go to market. Superhuman did this, for example. Even Gmail in the early days, it was all invite only. I was one of the early people to get invited to Gmail. So and people value that, the level of exclusivity. It can sometimes be a good thing. So you don't need 10,000 customers or 1 million customers to be a viable startup. You need to understand who your customer is and then figure out later, are there enough of those people in the world, hypothetically, to make this business viable, and what could that look like in that mature state? Going back to financial projections there as well. So this is a strategic exercise that you as a founder need to do in your business to understand how your product then ties into a market.
Okay, and Shaun, take the question.
How can I add to that? I mean, it's essentially, again, listen, you're both 100% right. I mean, there's really nothing more I can add to that. I mean, essentially, my whole philosophy regarding entrepreneurship, or just regarding, just existence, is that it's always better to be doing something than nothing. So even if you're working on a minimum viable product, and even if it doesn't work, you will have learned so much from that time that you can apply to something else than if you were just doing nothing. Let's just say, I don't know, watching Umbrella Academy season 2 on Netflix for the 5th time. I feel like, the work that you do, you gain experience from. And that experience, you might not, even if it fails, even if it doesn't work, years later, it might come back and say, oh, hold on a sec. I worked on something similar. I think I can do something now because I was maybe too early, or the market wasn't ready for me. I mean, these things happen, these things, just sometimes it's not ready. Society's not ready, but that doesn't mean you shouldn't be trying to do something. It doesn't mean you shouldn't be striving for it. It doesn't mean you should be putting, blood, sweat, and tears into a minimum viable product, because you should be prepared for it not to work. I think everyone has this notion that I'm going to create this. It's going to be great. I'm going to be a millionaire, and there you go, job's done. And really, 99% of the time, it's not going to work. And it goes back to resiliency. You have to be resilient to know when your MVP fails. And even more so, it has to be more resilient when your launch fails, because you could have a great product, but if nobody uses it, it's kind of like, okay, what's the point? So,
that's a good point you mentioned there, like about, it could always fail, and you want to be doing something that is worth failing at and worth pivoting from. If you're not doing something worth failing at and worth pivoting from, it's probably a good sign that you shouldn't be in business, as a founder, because that's something that, like, for example, you might test a hypothesis and realize it's completely false, but you have some product, something that can be used in a different use case. If you're not willing to go through that pain of completely making that 180, and it's painful, don't be a founder. Start a lifestyle business, maybe be a VC, because that's a lifestyle business. But
I like how you let them down so easily. I mean, if I ever have, we just start a business where you give bad news to people, because you're just so gentle with it. Don't be a founder; it's not for you. It's just so nice.
But it's a good point though to bring up, because I think what's the alternative? People waste years of their life and run around in circles. I mean, that's nobody's better off for it. Not them, not their family, not those around them. Like if you're committed to it, that means that you have convinced yourself, not because of delusion, but because if you're intellectually honest with yourself at the same time and saying, look, intellectually honest, I'm willing to fail at this because this matters enough, that's probably a sign that you're doing the right thing and adding enough value, at least convinced for you, which means the probability of you convincing somebody else is higher. If you think you're going to get one up on somebody else and, you know, like, hey, like I just figured this out and I'm going to arbitrage something temporarily, but it's not genuinely a huge opportunity and you're not willing to, you won't be willing to fail at it. If you believe that there's something missing, even if you're hiding it from yourself, you won't be willing to fail at it. And that's the qualifier, you know? So
yes, we can go on for ages, yeah. Shaun. I'll give you 30 more seconds, and then we definitely have to wrap up. And
okay, well, I'm just going to end it with a quote. I feel for every founder here, regardless of where they are in their fundraising journey or where they are in their founding journey, all you need, we're essentially believers, and all you need is to find a believer to believe in the believer. That's what it comes down to.
That's beautiful. That's amazing. Yeah. Okay.
Absolutely.
So thanks, guys, for today's episode. It was amazing. And I would like to announce our next episode that is happening on Tuesday in 2 weeks, as usual. So subscribe to our Eventbrite account to make sure that you will be there. And also there is this YouTube channel where we have the streaming of each episode. But it's better being here, right? Because you can ask some questions in the chat and like probably be the part of the show. And we see you in 2 weeks. At the evening in Baltic time and in the morning in Miami.
Good night, everybody.
All right.
Yeah.
Take care.
Thank you,
care.
everyone.
Bye.
Bye.
Thank you.